Welcome, everyone. Thanks for joining us today. We are going to give it just a minute for all of our attendees to cycle in because we have quite a few of you, and then Ryan will get started. Okay, hello everyone again, and welcome to GASB 91 and 94 Practical Applications. We're so glad you joined us today. Now, before we get started, we just have a few quick housekeeping items for you. This webinar is eligible for 1 hour of CPE credit. We're going to launch 4 polls throughout this presentation, so to receive credit, you must answer 3 of the 4 polls and also complete the short evaluation you will receive afterwards. Now, this evaluation email will be coming from Prolera, so keep a lookout for that in your email. If you're having trouble seeing a poll, try minimizing the Zoom screen because sometimes the polling question box pops up behind that. You may need to drag the Zoom screen around a little bit to find that. If you've got multiple screens you're using, check to see if the poll question popped up on one of those. This webinar is being recorded, and you're going to receive the recording link and slides emailed to you later today, so be on the lookout also for that in your inbox. This webinar is going to run 55 minutes, and Ryan would love to answer all the questions that come in, but because we have such a large number of attendees today, thank you all for coming, he's not able to answer all of them. However, we'd still like you to put your questions in the Q&A box, and we'll look for similar questions that come up, and he'll try to answer those that he can. And to find that Q&A box, just go ahead and hover your mouse over the top or bottom of your screen, and the Zoom toolbar will pop up, and you'll see the Q&A box. All right, now I'd like to hand it over to your presenter, LSL partner, Ryan Domino. Take it away, Ryan.
All right, thank you very much, Jill. Well, welcome and good morning, everybody. It's a pleasure to be presenting some great information about GASB 91 and 94. This is kind of a follow-up to the presentation I did back in May at our annual GASB update. So if you were there, some of this information will probably be a refresher for you. But if you're new, there's a lot of good stuff here too. Don't need a whole lot of backstory. So without too much further ado, let's go ahead and get started. Skip through the little disclaimer here. And so just a little bit about me. Like Jill said, I'm a partner here with LSL in the Government Services Department. Been with the firm now for about 11 years and basically spent that entire time working with local governments. To that end, I'm pretty involved in a couple of organizations, obviously AICPA, CalCPA, but also CSMFO and the GFOA. So with GFOA, I'm part of the Special Review Committee, where I review ACFRs on an annual basis from organizations all over the country for the Award and Excellence program. So if you get a ACFR submitted to the GFOA, it comes back with comments. I'm one of the people that reviews and provides the comments. Internally within the firm, I'm the Government Services Department's training lead. So I'm pretty much responsible for ensuring all of our staff and managers are well trained to go out and do their audits and are up to date on all the latest GASB pronouncements and accounting and auditing standards. And then my area of research and expertise is really in the Yellow Book sphere and uniform guidance. So I really spend a lot of my time researching federal award programs, grants, and other Yellow Book considerations to help my clients out. On a personal note, I'm married. I have 2 little kids, ages 3 and 4, and my family is actually going to be undergoing a huge life change next week when my daughter starts kindergarten. So hard to believe that that's already here, but it's coming up fast and it's happening. We're very excited about it. So just really quickly about the webinar, what the purposes are. I know pretty much everybody is focusing really close, and as they should, on GASB 96, the SPIDAs, the subscription-based technology arrangements, and that's really the big GASB taking effect this year. But we wanted to put this webinar on because there are 2 other GASBs that are taking effect this year as well. So you have GASB 91, which is your conduit debt obligations, and GASB 94, your P3 arrangements. And really the purpose of this webinar is to talk about what we believe are going to be the expected impacts to most local governments, what the expected changes to the financial reporting requirements are going to be for both of these GASBs, and then what to look for and how it could impact your fiscal year and 2023 audits. So to kick it off, we're going to start with GASB 91, the conduit debts. Not going to spend as much time on this one as it's probably the most minor of all the GASBs taking effect this year, but still good to know about it. Like I mentioned, we're really expecting minimal impact for this GASB. The way it was written was really meant for larger governmental organizations such as states and state agencies. We expect a much greater impact to those organizations. However, most local governments, at least that I've worked with, have conduit debts. Of my client listing, there's probably 25 governments that I work with, and of those 25, I'd say at least 15, if not more, have conduit debts. So these things are out there. There will be some impact. It just probably won't have the same level of change that it would for a larger organization, such as a large county or a state. Really, what we're thinking is going to be the major areas impacted by GASB 91 for most of our client base, most local governments, is going to be in the area of footnote disclosures. So just as a quick refresher, what is GASB 91? Why did it come out? What's the purpose of it? And really the objective of it was when the GASB did their research and looked around at all the different ways that conduit debts were being reported by governments, they found a considerable amount of variation and diversity in practice, especially when it came to certain disclosures. And like I mentioned before, I have about 25 clients that I work with. 15 at least have conduit debts. And of the 15, there's probably 10 different ways they're reporting it in the footnotes. So there is definitely a lot of diversity out there. And so the point of GASB 91 is to get everybody on the same page and make pretty much all government financial statements comparable to each other for consistency purposes and just ease of read for the users of financial statements. Particularly, there were 3 areas that the GASB found had a lot of diversity of practice in, and that's if there were additional commitments, which I'll discuss in a little bit, extended by the issuers, any sorts of arrangements such as leases that were associated with conduit debt obligation, and then just the related note disclosures were very diverse in practice on how people were reporting those. So the whole point is to get everyone on the same page. Again, as a reminder, just going back and talking about what conduit debts are, conduit debts have certain criteria. And there's 1, 2, 3, 5 criteria that all conduit debts have to have. The first one is 3 parties. So any conduit debt is going to have an issuer. So that's the organization whose name is actually on the debt. You have the third party obligor or TPO. This is the person who is actually paying the debt or organization that's actually paying the debt. And then, of course, you have the debt holders, the investors who have purchased the bonds or debts. Other criteria involved here is that the issuer and the TPO cannot be within the same reporting entity. So what that looks like and what that means is if you have a public financing authority blended component unit that they're issuing debt, and then the person or organization ultimately paying it is the primary government, that doesn't count. Even though there's technically 3 parties, the public financing authority and the city, for example, are the same reporting entity, so not a conduit debt. The next one is the debt obligation itself cannot be a parity bond of the issuer or otherwise cross-collateralized with any other debts that the issuer might have. If any of those situations exist, it is not a conduit debt. And then the last 2 really talk about the TPOs. So the TPO or third party, they ultimately get the proceeds of the issuance of the debts, and they're ultimately primarily obligated to make those debt service payments. So the majority of our organizations that we work with and where we see these very frequently are in CFD or assessment district bonds. A lot of these meet the criteria of conduit debt. One other feature of conduit debts that is unique to them is that the issuer pretty much only has limited commitments in most cases. In most instances, it's going to be just maintaining the issue's tax exempt status. So it could be going back to our example of a CFD or assessment district bond. They're issued in the name of a local government to give them federally tax-free muni bond statuses. Some other limited commitments that are pretty common include facilitating debt service payments. So in this case, the issuer is basically setting up a bank account to facilitate the disbursements of the bond payments to the bondholders. Both of those are very common, and they are called limited commitments. If these are the only things out there, the accounting for it is pretty easy. It doesn't change a whole lot, so that's the good news. The GASB also does cover what's known as additional or voluntary commitments, and they specifically cited 4 examples. One is a moral obligation pledge. So if that's written into the agreement, it's an additional commitment. Appropriations pledges, extensions of financial guarantees, or pledging the issuer's own properties, revenues, or other assets as a form of security for the debt, all constitute additional or voluntary commitments. And that's where the accounting changes. So as you're going through your conduit debts, make sure you're checking them out to make sure if there are these additional commitments that we're considering them for accounting changes. The key thing here is if you do have a situation where there's a voluntary or additional commitment, that you're periodically, the GASB says annually, evaluating whether it is more likely than not, which is basically accounting speak for a 51% chance, that the issuer, that would be your organization in most instances, will make a debt service payment for the TPO. And if that's the case, if there's a 51% chance of that happening, you're going to have to actually recognize a liability on your books. So when you're evaluating your conduit debts and you've extended a voluntary or additional commitment, make sure you're considering some of the following. If the third-party organization is entering into bankruptcy proceedings, if they're in a breach of contract related to the debt, if they're experiencing some sort of significant financial difficulty where it's becoming unclear whether they'll even be able to make payments, if the project that was going to be the source of funding for the debt payments, if that got terminated, or if there's some sort of significant litigation that's going to hamper their ability to make debt payments, you probably should really consider that. What is the chance that we're going to have to do it? So after looking at them, you have to look at yourselves. Do we as the issuer have a history of fulfilling additional commitments? Have we done it in the past for other TPOs? Also, what's our ability and willingness to support debt service payments? It could be all well and good that the third-party obligor has no ability to make the payment, and we want to help them. We made the commitment that we would try to help them, but do we actually have the ability financially to make the payment? So be evaluating on an annual basis if there's a 51% chance of it happening, and then consider whether or not we actually can make it happen. All right, so this is a good stopping point for a poll question. We'll run it in the background. And again, just as a friendly reminder, if you are running dual screens, check your other monitor, maybe minimize your windows and see if it pops up. It'll be open for a few minutes, so I'll go ahead and continue while it's open. Okay. So getting back to the accounting changes, what's it going to look like for us if we have conduit debts? The good news is, I think for the majority of local governments, we're not going to see a whole lot of change to the financial reporting. In most cases that I've seen conduit debts out there, there's really no additional or voluntary commitments that were made. It's more just limited commitments for the purposes of maintaining tax exempt status and facilitating debt service payment. So in that case, really all you have to disclose is the description and the conduit debt of the conduit debts in the footnotes, and then also the aggregate remaining principal balance on those debts. So pretty straightforward. I would say the vast majority of governments that have conduit debts already do this. So it's just a matter of if you prepare your own financial statements, just make sure it's there, make sure it's doing those things, and you'll be solid. And if you're an LSL client, we prepare your financial statements for you, you'll be set. Just make sure we put in the right numbers. For local governments, where there is an additional or voluntary commitment that has been made, but you haven't incurred any sort of liability yet, you're going to do the same thing. So you're going to have that same basic description, the aggregate amount outstanding, but you're going to want to write in an additional description of what those commitments are. Finally, the third situation would be basically where you've made this additional or voluntary commitment. And after evaluating those conduit debts, we determined, well, it looks like we're going to have to help out our third party and make some debt service payments. If that's the case, we've incurred the liability and we have to now measure it. So in your financial statements, you're going to accrue a liability for the present value of expected future payments. I'm sure we're all getting really tired of hearing about present value calculations. We're going to talk more about it in a little bit, but the GASB absolutely seems to be in love with something which previously accountants didn't really deal with too much. We usually only dealt with this if you were, a finance major or something like that, but it's creeping its way into accounting. And then after you've measured your liability and you've recorded it on your books, in your footnotes, you're going to disclose some additional information. So not only a description of the conduit debt, not only a description of the commitments now, but instead of just the outstanding balance of the principal, you're now going to have a schedule of beginning balance, increases, decreases, and ending balance. Very, very similar to how we do for any other long-term debt. You're also going to have to disclose the valuation method, so more or less the estimates that went into calculating that liability. And then you also have to disclose any cumulative amount of payments that you've made on behalf of the TPO. So a little bit of a difference there if a liability has been incurred. So how is this going to impact your audit this year? Really, the key thing is make sure that you are evaluating your existing conduit debts. You're going through the listing that you have. Check to see if there were any additional or voluntary commitments made beyond just maintaining tax exempt status. And then if you have made those types of commitments, make sure you're estimating the possibility of making payments on behalf of the TPO. Remember, if it's a 51% or more chance that it's going to happen, we'll have to accrue a liability. So additionally, some things that you will probably get requested from your auditors is a description of any conduit debts that are out there, a description of any commitments that you've made if necessary, the schedule of beginning balance, increases, decreases, and ending balances of the liability. So this is probably part of your long-term debt PBCs already, but if not, you should have it. If you had to estimate the liability for any sort of conduit debts, you'll have to put together a PBC explaining that and showing the calculations because your auditors will want to check it. And then, of course, this will probably be in the same spreadsheet, but for disclosure purposes, we'll need to know how many payments have been made or plan to be made on the conduit debt. So that's GASB 91. It's pretty straightforward. Like I said, don't expect too much impact going forward. So we're going to spend the majority of our time now on GASB 94. So I'm going to tell you a really quick personal story about me. So I have 2 siblings. I'm one of 3 boys, and I'm the oldest. I have 2 younger siblings. And so GASB 94 is pretty similar in its relationship with GASB 87 and 96, as you would think of them as siblings almost. And GASB 87, again, take this with a grain of salt. Nobody get too upset with me, but in my experience, The oldest sibling and the youngest sibling are the troublemakers, and the middle one is the most easygoing. When I was a kid, I was the troublemaker for my parents because I was the first one. I would get into trouble. My brothers would see it, and they would learn from it, hopefully, in some instances. My middle brother was very easygoing, probably the easiest child for my parents to raise. His laid back personality, very, very nice guy, easy to get to know. And then my youngest brother was always in competition with me. So it was a lot of headache for my parents between the two of us. And GASB 87, 94, and 96 are kind of in the same boat. 87 last year was probably a pain for a lot of people to implement because it was new, it was a struggle, and there were a lot of it. 94 is the laid back middle sibling. Not too many impacts we're seeing so far, easy going, not too much of a challenge. And then 96, as I'm sure most of you are experiencing right now, is a headache like 87. So it's just a funny little analogy I like to think of as GASB 94 being the mellow, laid back middle brother of the three. So what do we expect to see with GASB 94? So far, what we're seeing is relatively few of these P3 arrangements out there, but we do expect that as public-private or public-public, which is what the P3 comes from, as we see more of these arrangements becoming common, it will likely have a greater impact. So right now, I mean, obviously leases was a big deal. SPIDA is a huge deal. In 94, we're kind of expecting to grow over the years. The good news is with GASB 94 is that the accounting is the exact same as leases. So everything that we learned last year in terms of journal entries and implementation, it's all pretty much the same. So the calculations are the same. It's just the focus of the underlying asset that's different. So that's positive. And then the other expectation that we're seeing this year is that most local governments will likely be in the role of transferor. So transferor is GASB 94 speak for lessor. So think of them as interchangeable terms, although transferor is the proper term for public partnerships. So GASB 94 governs transactions wherein a government and another entity, which can be either another government or a private sector entity, enter into some sort of arrangement wherein the other entity is given rights to use an underlying capital asset to provide a public service for a determined amount of time in exchange for consideration. That was taken straight from the GASB. You're probably tired of reading GASBs. I know they're not the most enjoyable thing to read. So pretty much, to put it in plain, simple, non-GASB language, it's a situation where we have an asset that we're gonna lease out for a set period of time. There is a term. Our other organization that we're partnering with is gonna pay us for the right to use it. And they're gonna use that asset to provide a public service, something that we as the government would provide our own citizens. So that's a little bit of a difference there. And then the critical difference between GASB 87 and 94 is the focus of the underlying asset and the status of the underlying asset. So that's the big difference between them. Otherwise, they're essentially the same. So the big difference with the asset is with leases, that underlying asset already exists. It's on your books and it's going to be used for the lessee's purposes. So the example that I like to give here is maybe you're a city, you own a building and you're leasing it out to, say, a restaurant on your main street. Obviously that restaurant is in it for profit. It's for their own purposes and they're just paying you rent to operate in your building. So that's an example of a lease. In a P3 arrangement, typically what we're going to see is that the underlying asset does not currently exist, or if it does, it's going to be improved upon by an operator, and it's going to be used to serve the public purpose of the transferor or the lessor. Where we're probably going to see a lot of this, and where we've seen it with a few of our clients so far, is in golf courses. So if you have a golf course, take a look at it. golf course in an arrangement that we've seen, it exists, but the operator, the management company, is going to maintain it and actually improve upon it. And it's serving the public service. So it's a city-owned golf course. It's providing golf course recreation to the residents. And so therefore the operator of that course, they can't turn it into, you know, a botanical garden or something like that. It has to continue to be a golf course. So that's really the big difference between leases and P3s. Also going to take a minute here and talk about service concession arrangements as they were rolled into GASB 94. Some of you may remember that previously service concession arrangements were governed under the terms and conditions of GASB 60. But after doing their research and writing up 94, the GASB board really determined that service concession arrangements are a form of P3. And so they did carry over the same criteria that was previously in GASB 60 over into GASB 94. And so as a reminder of what those criteria are, you have a situation where there is an underlying asset and the operator, so that's the third party, could be public or private, they're paying the owner of the asset, the transferor or the government, for the right to operate that asset. The operator of the asset is going to be compensated by customers, recipients of the services provided, whomever, not directly by the government. The government or transferor, they retain the rights to set the fees and also determine what services are provided. And then at the end of the term, the asset reverts back to the transferor at the conclusion. So those are the four criteria. And actually, the example I gave you earlier with the golf course was a service concession arrangement. So it fell into that. Okay, so I think now we can kind of switch over to polling question 2. Does your agency have any P3 arrangements? And that'll be open for the next minute or so. Check your hidden screens. Okay, so talking about financial reporting for P3s, I mentioned earlier we were going to dive into present value calculations in a little more detail. If you'll recall from my GASB update back in May, I didn't really talk too much about what it looks like or how to calculate it. Today, I'm going to remedy that. So for those of you who are not utilizing a software solution for your P3s or SPIDAs or leases, anything like that, you can actually utilize Excel. Excel has a function that, or a formula rather, that lets you calculate out your present value. And so the first thing that you're going to need in each component of the formula is you need to know your annual interest rate. So if the arrangement has a stated interest rate, that makes it nice and easy. It's going to be that 3% or whatever divided by the number of payments per year. And that gives you the rate for the Excel formula. Where I'm going to say there's going to be a hiccup is most of the arrangements and leases and even SPIDA that we've seen so far don't have stated interest rates. Many times it's just pay us $10,000 a month or, you know, whatever the service is. So there isn't a stated interest rate. In that case, you know, reach out to your auditors, reach out to your software solution and see if they have a way or a tool to help you calculate or estimate your incremental borrowing rate. This is essentially an estimate of what the interest rate would be based on a number of factors that go into it. There's a number of different acceptable ways that you can calculate your incremental borrowing rate. I know for us, if you're an LSL client, we have a spreadsheet that we've been sharing with our clients since '87. Took effect last year, and we would continue to provide that if you needed it. The one hiccup I will say about the incremental borrowing rate is that because it is an estimate, we would expect the incremental borrowing rate to be consistent across P3s, SPIDAs, and leases. We would not generally expect to see different incremental borrowing rates for all three of them. So if you have, you know, a 3% incremental borrowing rate for leases, but a 5 for SPIDAs and a 2.5 for P3s, that's going to be a little bit unusual and will likely be questioned by your auditors. So once you have your annual interest rate, obviously you're going to want to look into your agreement to find the number of payments and then also the total amount of each payment. And then just plug that information into Excel and it'll come up with a present value calculation. So pretty straightforward. Another thing, if you're not using a software solution that you're going to want to utilize is some free templates that Excel has on loan amortization schedules. So I know that P3s typically are going to be from the lessor, if you want to use that terminology side, but it's going to be the same thing. So you're going to have a receivable. You can treat it like almost like a receivable and utilize the loan amortization schedules to determine how much of each payment is related to principal and how much is related to interest. And you'll definitely want to get one of these things either from, you know, your software solution or use with the free template in Excel, because without it, it's going to be very difficult to do the journal entries. And then finally, the deferred inflows, which are more or less going to be the offset of any receivable of the future present value of the lease payment. You're going to want to amortize that over the life of the arrangement. Strongly recommend amortizing it straight line, although the GASB does allow for other methodologies. If you want to avoid headaches, I would strongly recommend just sticking with straight line. So this is just a quick example of what that loan amortization schedule that you can utilize for free in Excel looks like. So after calculating your present value, just put it in the loan amount, put in your annual interest rate, whatever, or incremental borrowing rate that you're using, and your P3 term, and it spits out an amortization schedule, which is very handy. So strongly recommend utilizing this if you're not doing a software solution. Okay, so this is where things are going to cause people headaches if you're like me and are a little bit OCD about numbers matching. Outside of the initial recognition of your receivable and the offsetting deferred inflow of resources, the numbers will probably never match again. So as you're recognizing payments on the arrangement, you're going to be reducing the receivable, right? Based on that amortization schedule I just showed you. However, your deferred inflow of resources, if you're amortizing it straight line, it's not going to match up. So the amount of receivable you reduce is not going to equal the amount of revenue that you recognize, which is going to be probably frustrating. But if they do match, you're not doing it correctly, and something would probably need to be looked at a second time. So the next couple of slides, bear with me on them. They're going to be probably not the most exciting part of this presentation, but they do go over the journal entries for three prospective situations. The first situation that we're going to look at is the journal entries for when an asset exists on the outset of the arrangement and is going to be improved upon by the operator. The second situation we'll look at is when the asset is going to be constructed or acquired by the operator, and the arrangement is a service concession arrangement. And then finally, the third one will be same as before. The asset's going to be new construction or new acquisition, but it's not a service concession arrangement. So let's go ahead and take a look. So in our first example, we have a city entering into an arrangement at the beginning of the fiscal year, July 1st, X1, with XYZ Company, which is a golf management group, and they're going to operate and improve the golf course over the next 5 years. The improvements are expected to cost $50,000, and XYZ is going to pay the city $10,000 per month for the rights to operate the golf course. The incremental borrowing rate in this example was determined to be 3%. So using Excel, that present value calculator, we calculate out our receivable to be about $556,000. we have a capital asset of 50, and we're offsetting it by the deferred inflow of resources, which is more or less the plug of those two amounts. So in this situation, because we already own the asset, the improvements on that asset, we're going to capitalize at the outset. So that's why you're seeing capital outlay being debited, and then ultimately will be capitalized in your gov-wide statements. So at the end of the year, we're sticking with that same example, but at the end of year one, you're going to recognize probably $120,000 in cash, 12 months, $10,000 per month. You're going to amortize the deferred inflow amount. So whatever, it was about that $600,000 amount divided by 5. You're going to reduce your receivable by the principal amount on the amortization schedule. And then interest revenue is pretty much the plug. So this would be the journal entry after at the close of your first year. So looking at the second example now, so remember this is a service concession arrangement. City enters into a service concession arrangement with LMNOP Company, which is a real estate developer, and they're going to construct and manage our low mod income housing for 50 years. This property is expected to be able to sell for $10 million if it were placed on the real estate market. And LMNOP is going to provide us or pay us $10,000 per month for the rights to manage the housing project and collect the rents from the tenants. Again, our incremental borrowing rate, we'll say, is 3%. So in this case, because it is a service concession arrangement, we're going to recognize that capital asset, that housing development, right out of the gate for $10 million. We're also going to recognize the present value of all future payments on the arrangement in the amount of $3.1 million. And then the deferred inflow of resources is basically the sum of the two, and it's just basically the plug. So that's at the start of the year. At the end of the year, we're going to have to true it all up pretty much. So we're going to recognize all the cash that we received as part of the arrangement. We're going to amortize our deferred inflow of resources that I think it was $13 million over 50 years. So 13 divided by 50 gives us that $262,000. We're going to reduce our receivable by the principal amount that we determined in our loan calculator. And then again, offset the plug basically by interest revenue. Okay. In our third and final example, we have again a situation where a city enters into an arrangement with ABC Company. And what they do is they're telecommunications, and they're going to construct fiber optic internet lines throughout the city in exchange for exclusive access to provide internet services to customers for 5 years. These lines are expected to have a carrying value at the end of the agreement of $1.5 million. And again, they're going to pay us $10,000 a month for the rights to use these lines, and our incremental borrowing rate is 3%. So because this is not a service concession arrangement, this is where it becomes a little bit different. So instead of recognizing any assets at the outset of the arrangement, we're going to recognize a receivable for the asset plus the receivable for the present value of all payments and offset it with the deferred inflow of resources. So in this case, it's just a receivable and just a deferred inflow. At the end of the year, we're doing the same thing. We're just recognizing all the cash we've received, amortizing our deferred inflow of resources, straight line method, reducing our receivable by the principal amount, and then plugging the difference to interest expense. However, this one, because we didn't recognize the asset out of the gate, let's jump forward to the final year of the arrangement. So at the conclusion of the agreement, we're going to do the same thing. We're going to recognize all the cash we've received. We're going to reduce our final amortization of the deferred inflow of resources. However, the big difference now is we're going to recognize our capital asset. So we're going to debit capital outlay, capital asset if you're full accrual, and we're going to credit the remaining balance of the receivable. So that's the big difference. In a service concession arrangement, you're going to recognize the asset on the outset, of the arrangement. Whereas if it's not a service concession arrangement, you won't recognize the asset until the end of the arrangement. So what does it look like for your financial statements? In most cases, because we expect most governments to be on the transferor side or lessor side, if you want to think of it in those terms, you are going to have transaction in the fund level. So if it's in your general fund or whatever fund is home to the transaction, you're going to see a receivable in that fund. You're going to see a deferred inflow of resources there as well. It's not just going to be in the government wide. And then in your note disclosures, some key things to make sure are present is a general description of the P3 arrangement. You want to talk about why it's there, what it's doing, what the term is, all that good stuff. You want to disclose the nature and amounts of the underlying assets and deferred inflows of resources. You want to also disclose the discount rate or incremental borrowing rate used to measure the receivable. You're also going to want to disclose any the total amount of deferred inflows recognized during the period as revenue. And then finally, some other things, general information. So if there's any sort of rights retained by you as the transferor, or if you've granted special rights or privileges to the operator with respect to the asset that go outside of the normal note disclosures, you want to make sure we're talking about that. And then we also want to make sure that we are discussing any sort of provision for guarantees or commitments, again, that go above and beyond normal P3 arrangements that readers of the financial statements would be interested to know about. And so I think now is time to launch our third polling question. Again, make sure you're checking behind your screens, minimizing stuff in case you don't see it. Have you evaluated your contracts for management services for possible P3 arrangements? This is probably where you're going to find them. Okay, so while that's running, I think we'll talk about the final thing is audit impacts. So really the key things to be on the lookout for here is, like we've been talking about leases and SPIDAs for the last couple of years, really make sure you're evaluating your arrangements with management companies or developers. For terms and conditions, that would be indicative of a P3 arrangement. If it's a simple situation where they're paying you, you're paying them to run your golf course, that doesn't count. That's not going to be a P3 arrangement. But if they're paying you for a right to use your asset, really be evaluating those contracts and make sure that if they are P3s, that we're recording them as such. There's situations, I've had a number of my clients reach out to me already, and as auditors, we're always happy to discuss these types of things ahead of time and hopefully head the problems off at the pass, so to speak, and get things recorded correctly before the audit, right? So if there's any questions that come up, be sure to connect with your auditors and see if you can both come to an agreement as to whether or not an agreement would be a P3 or not. And then just some things to look out for, we kind of went through this last year with leases. So a lot of the PBC requests that you will likely see from your auditors are going to be similar. So you'll probably get asked for listings of P3 arrangements that are active during the year, because your auditors are going to want to take samples from it. They're going to want to verify that items that you've identified as P3s actually are P3s. And so from that listing, they're going to take a sample. You'll probably be asked to provide those agreements so they can validate the terms and conditions. Any calculations that you either are doing in-house with Excel or some other solution, or if you're utilizing a software solution, they're going to want to see the calculations that are going into that, or the present value of the receivable and deferred inflows. And then finally, just any of the other information necessary to properly disclose P3s is going to be kind of the critical thing. So with that, I think we go to our bonus polling question number 4, in case you missed one. do like present value calculations as much as the GASB, and I really am curious to see what the results of this one would be, but it's pretty much that. So we have a little bit of time left. Be happy to go through the Q&A and see what questions we have. Okay, so we have one question here about for the incremental borrowing rate. Do we have to calculate a new IBR for amendments to the contract, or would they carry the same rate as the master contract? I would say that, it should probably carry the same rate as the master contract. You would generally want to, if you're going to reevaluate your interest rate, you're going to do it for the whole master, more likely than not. So I would recommend the master rather than amendments. Okay, let's see. We have another question here. If you have a building that a group uses for concessions at a ball game, and they give a portion of the proceeds back, such as 10% for allowing use of the building, is that a P3? Maybe. I would say more likely than not, it is not. The only reason being, it would depend if it's a city-owned ballpark, I suppose, or a city-owned asset or government-owned asset, I suppose is probably the better term. Could potentially be a lease or just a use agreement. I would probably have to see more on that one to give you a more defined answer. We have another question here where it is a situation where a school and a city park district, one owns the land and they both invest funds to develop it for both parties to use. Neither pays each party to use it, but have an agreement of schedule of use. Is that a P3 under GASB 94? For this one, I would say probably not, because there's no consideration being given from one party to the other. Also, I mean, it would depend if there's a term or not. I would assume that there probably is not necessarily a term here, or if it is, it's annual type thing. So, but just based on the fact that no one's paying anybody, I would say probably not. Okay. Next question is, if the transferee is not making improvements to the golf course, but is paying $10,000 per month to use, is that a P3 or a lease? It would depend. So it could very well be oh, Jill, do you have something on that? Oh, I'm sorry, never mind. I'm getting distracted. Is that a P3 or a lease? So in that situation, it would depend. If it was entered into a number of years ago, it could have been a P3 at the time of onset, right? Typically with a P3 though, there has to be some improvement to the asset, the underlying asset. Otherwise it probably is a lease, is how I would look at it. All right, let's see. Oh, here's a good one. Our county has such an arrangement, but was over 20 years ago, and the private entity is not going to improve the building. Does it still qualify for GASB 94? Most likely, probably not. There typically with 94, there needs to be some sort of improvement on the asset. Otherwise, it's going to fall under the leasing terms. Another good question here. Do existing franchise agreements, are they affected by GASB 94, such as solid waste disposal, cable, internet? Most likely for your franchise agreements, probably not. Yeah, those are generally would not be affected. You may want to take a look at some of the agreements, but in most cases, we're not seeing too many being affected there. Okay, so we have a question here about a situation where there's a golf course, we have a private company operating it, but we collect all the fees. In return, we pay a management fee to the operator, and we also pay for their operating expenses. Is this a P3 arrangement? And in this situation, no, you don't have a P3 arrangement. And the reason for that is you're more or less paying them to operate your golf course. It's almost, think of it almost as outsourced employees of your organization operating it for you. So they're not paying you anything to operate the golf course, you're rather paying them. Okay, good question here. Do we consider materiality thresholds for P3 arrangements similar to 87 and 96? And with that, the answer is yes. You always want to consider materiality. Typically, what we recommend to our clients is that you would use the same materiality for P3 arrangements that you would for SPIDAs and leases. They're essentially the same thing, just with a different outlook, if you will, different underlying asset. So always consider materiality. If it's super tiny, probably isn't worth your time, but still should be considering it, you know. Is there a good checklist tool to aid in the evaluation of P3 arrangements? There is actually one. I saw a great presentation actually a few weeks ago from, I believe it was CSMFO. They put on a great webinar talking about the GASB update, and one of their slides had a pretty sweet, pretty slick flow chart. I'd recommend that one if you can find it. Otherwise, you know, maybe just reach out to your auditors and see if they have a tool for you to use. Okay, so then the next one, if the operator pays a city based on each month's sales, not a fixed payment, this is not GASB 94. Is it a 94 situation? The answer to that is it could still be a 94 situation. The terms of the agreement might be a little bit different, but if they're paying you to operate an asset for a defined term to provide a city benefit, regardless of whether or not it's fixed or variable, it could still be a P3 in that situation. Let's see, kind of talked about franchise fees. Typically, no, they're not going to be P3 arrangements. Do you need an actual contract or agreement to consider it a P3 arrangement? That's a good question. You know, always when you're doing accounting, you have to consider substance over form. So it could be a situation where you might have I don't know, a verbal arrangement. I wouldn't ever recommend doing verbal agreements, but if it's set up in the manner of a P3, even if it's not a actual contract or agreement, it could still qualify. So lack of actual contract or agreement does not dismiss it from being a P3. Okay, so the next question here, that I think would impact a lot of people is, our city leases a building for $1, and the premises are to be used as a community theater facility. Improvements are the responsibility of the city. Is it a P3? And this one I'll expand on a little bit in terms of the answer. It is never going to qualify as a P3, as a lease, anything, because $1 is not equal consideration for the services or good that you're providing. It's not an exchange transaction. So any sort of dollar leases or anything like that are never going to qualify under GASB 96, 94, or 87. Okay, I think I have time for one more question here. This person says, we constructed the fiber network and we leased to a third party who leases to customers. We accounted for GASB 87. Should it now be considered 94? And the answer to that question is no. So you constructed the fiber network and you're leasing it out. Therefore, it is a lease. It's not something that you are going to get in the future. So 87 is the correct GASB. So I think that's actually the end of our webinar. And so thank you all for attending. Really appreciated the opportunity to present GASB 91 and 94 to you, and I'll turn it back over to Jill.
Thank you, Ryan. Wow, a lot of information was covered today, and I think what I learned is that I had no idea you were a troublemaker, because as long as I've known you, you were anything but. So it just goes to show you, kids don't always turn out as adults the way you think, right?
Yeah.
I want to thank all of you so much for coming. A couple of reminders: you will be getting a copy of the slides and a link to the recording emailed to you later today. So be on the lookout for that in your inbox. Also, if you answered 3 of the 4 polling questions, be on the lookout for an email from Prolera with a short survey. Once you answer just a few questions, we will then be able to get your CPE certificate over to you. So please look for that email in the next 24 to 48 hours. And if you have any questions, comments, you know where to find us. And lastly, wanted to make sure you realized, if you need even more GASB, we have help with that. I popped in the chat link to LSL partner Kelly Telford's GASB 96 Lost in Translation Implementation Challenges No One is Talking About webinar that she did a few weeks ago, a debt book. So be sure to click that link in the chat if you wanted to watch that. You can also find it on LSL's website under previous webinars, and that's under the resources tab. So once again, we want to thank all of you for joining us, and make it a great day. Until next time, see you later. Bye-bye.